A lot of people ask me, when do I exit the market once I've bought in? Now that's a great question, and it really depends on your personal goals for investing in crypto assets. This section is all about exit strategies. At the end of this section, you'll be able to develop a framework for exiting trades and establish and set stops to manage your risk. There seems to be a belief in the crypto trading community that it's never a loss until you sell. But don't think of it that way. The reality is, it's never a profit until you sell. Now, a lot of trading strategies focus on where you should buy, but the truth is, you should really consider where you sell. So in this lesson, we're going to talk about exit strategies. And there's two variables to exit strategies that make them so key to your performance in the markets. One, they determine whether you'll make a profit at all, and next, they determine how much of a profit you'll actually make. So exit strategies are even more important than entry strategies because of these two variables. There's a saying in the market, cut your losses short and let your winners run. But how exactly do you accomplish this? Now, there's a couple exits that minimize losses that I want to talk about. The first is the initial stop loss. And this is usually entered when you enter the market and you put a stop loss below where the market is trading so that if the position moves against you, you sell and protect the rest of your capital. Next is the time stop. Now, the time stop isn't necessarily a price level. However, if the trade that you had entered in doesn't seem to be working out, you give it a certain amount of time and then you sell. And lastly is the trailing stop. Now, trailing stops are key because they'll move with the market. So if you buy, let's say, Bitcoin at 10,000 and the price moves up to 12,000, your initial stop, which might have been $500 below your entry point, will move up to 500 below where the market is currently trading. So these trailing stops will help you lock in a profit once the market starts moving in your favor. So let's think about how we're going to maximize profits once we get into a trade. Now, there's two exits that can help you with this. One is using an average true range trailing stop that's 2.7 to 3.4 times the 10-day average true range. And I'll show you that in a second. The next is also channel breakdown stop. So as I showed you in a previous lesson, when markets are trending and they're in a channel, if they break out of this channel, that's where you want to put your stop. So let's get into this right now, and I'll show you how to set stops up on Coinigy, a very popular trading platform in the crypto world. Now, Coinigy is a platform that allows you to access different crypto markets all from the same trading station. So think of Coinigy like a TD Ameritrade or an E-Trade. You can access New York Stock Exchange or the CBOE from E-Trade. Same thing with Coinigy. It allows you to access the Bittrex exchange or the Poloniex exchange or every other exchange you've signed up for. Now I want to show you how to set up a stop in Coinigy using average true ranges. And right now we're looking at a chart of Bitcoin versus the US dollar. This is on the Bitstamp exchange, and this is the daily chart. So each one of these candles, remember, represents 1 day in trading. Below this chart is the average true range, and this is a 10-day average true range. So it's giving me a price movement or an average price movement of Bitcoin versus the dollar over the last 10 days. Now, you'll notice here that the average true range tends to spike when the market's more volatile, and then it starts to come into a lower price point when the market's less volatile. So the average true range I'm looking at right here is about 1,000. Okay, and if I were to buy Bitcoin, let's say at this price point, 10,000, I want to use 3 times the average true range to set my initial stop. So 3 times the average true range, 3 times of 1,000, gets me 3,000. So this is a guidepost to how much lower from the market that I set my initial stop. So 7,000 here on Bitcoin is going to be like putting a stop order down here. Now, the reason why it's important to use the average true range is because you want to understand how volatile is the market, and you want to put your stop far enough away that any short intraday or multi-day moves don't knock you out of the position. If you're constantly having your stops violated because you're putting them too tight, then you have to go back and buy that position again. Now, average true range is going to change for different time frames. And let me show you what it looks like on a 4-hour chart. Now you're looking at a chart of Bitcoin versus the dollar, 240 minutes for each candle, which is 4 hours, and this is on the Bitstamp exchange. And the first thing you'll notice that in the 4-hour time frame, the average true range is much less. It's not $1,000 anymore, it's 300. So our stop loss is going to be 3 times 300 if we're talking about shorter time frames. So if your initial buy of Bitcoin is at 10,000, then your stop is going to be $900 below at 9,100. And this stop will give you enough room to let the market move up and down before it makes its move higher that you're expecting. So it's key to understand what time frame you're considering when you're looking at an entry strategy in order to put your exit at the appropriate point. So this concludes our section on exit strategies. Remember, exits are key in determining not only whether or not you'll make a profit on a trade, but also how much profit you'll make. Now, after this lesson, you should be able to develop a framework for exiting trades, and also you should be able to establish and set stops to better manage your risk.